Hi everyone, it's Jab out another video. Today I'm going to be talking about General Motors, of course, titan of American industry, one of the biggest car companies in the world, now a $56 billion company, so far from where it once was. On a yearly basis, it's decently off its 52-week low of $30, up around 30%, and now $38.5 roughly. However, decently off its 52-week high as well of 67, so that's down 37% year to date, after having a pretty good run in 2021 and 2020. It's now currently sitting at a price to earnings ratio of 7. Some nice news came out recently. The Q2 earnings released a decent insight on the plan for the future, and I thought it was pretty good. I think it's worth people's time to look at this business because there is more electric vehicle plays than just the new up and comers and Tesla basically. So let me know what you think. Like and subscribe and enjoy the video. Let's get into it. I'm a big fan of General Motors CEO Murray Barra, and you can see by how they see the investment opportunity and the medium-term strategy. This is extremely bold. They expect to double the revenue to around $275 billion to $315 billion by 2030. They expect a 50% compound annual growth rate on software and new businesses and a 4-6% compound annual growth rate from strong core auto business. So a lot of that software will be the cruise automation software essentially. They expect to see significant margin expansion, 12 to 14%. So basically with the scale and battery cost decline, so economies of scale essentially, and new business margins in excess of 20%. Again, the software, they believe they have world-class manufacturing capabilities, which is hard to argue against considering they've been a high-end auto dealer for many years. World-class manufacturing capabilities, they're targeting 1 million units of annual EV capacity in North America in 2025. That's a significant jump from where it is now. Announced significant battery capacity across 4 battery cell manufacturing companies, 3 EV programs in North America, each with an annual production of more than 125,000 units, with opportunities to expand by the end of 2025. This is all very compelling. That's not even to really mention the cruise automation software and Ultium. Ultium is a key enabler in launching high volume EV products. They reckon that will be a 20 billion to 25 billion annual software and services revenue section of the business by 2030. And Cruise is essentially the driverless software, which is making big strides in working with regulators. Received the first ever driverless deployment permit granted by the California Public Utilities Commission. This is a major milestone, of course, and it is not bringing them realistically any closer, but they believe this is inching them closer to generating $50 billion in annual revenue by the end of the decade, which would be absolutely insane considering they're producing no revenue right now, that segment. And it's a severe loss. Well, it's not severe loss causing, but it's causing losses for the business. So that would end up as a $50 billion in annual revenue. What an incredible turnaround that'd be. One thing that I think has been too easily discounted in the argument that legacy automakers are going to get eaten up by newer EV companies, particularly Tesla, is brand. Brand is huge in the car industry, nameplate is huge. I think Chevrolet has been a long history of building up, and other General Motors products in general, but particularly Chevrolet, has a long history of building brand, and people are very loyal to it. They've recently released or have spoke about three EVs they're going to release, high volume EVs starting 2023 across every price point. So the 2024 Silverado going to be around $42,000, which is relatively cheap for a pickup with 400-mile range. 2024 Blazer EV at $45,000 and the 2024 Equinox EV at $30,000, which is going to be one of the most affordable EV options in a very high volume segment. This shows that really aggressively targeting a wide range of price points and lifestyles quite early on in the EV journey, which is very impressive to me. As I mentioned, they're now making the first strides with Cadillac, starting to build some momentum. They're actually getting into production of the Cadillac Lyriq. It's received really quite high praise from the media. Core here stands with the Escalade as one of the best Cadillacs ever built, so a decent market reception, a relatively fast charge time, decent range, $63,000, so a little above the mid-range in my opinion, but it's attracting a lot of customers. 70% of people buying are new to Cadillac, 30% from the West Coast region of the US, which is not a traditional heartland for Chevrolet. Or Cadillac, excuse me. So I think they're doing well. Of course, these cars need to be good. They need to be making hits early on with these, or they'll lose that brand and they'll be known as a maker of poor EVs. But everything I've heard so far has been positive, and they're really starting to move away from just the Chevrolet, just the core brand essentially, and moving into Cadillac and Hummer. So this kind of completes the product range, a wide cost range, $85,000 starting price for the Hummer 2022 EV pickup, and the 2024 Hummer EV SUV, again covering a wide range of products at a wide range of price points. Very impressive. 42% of reservations are new to GM, which is incredibly impressive considering this is a company with incredible amount of brand loyalty. I really think they're getting a lot of momentum in the major southern states: California, Florida, Texas. 80,000 reservations with momentum growing. Really, really impressive. To go with the push for widespread adoption of EVs and trying to sell a host of new products, they're also investing a lot in infrastructure. They're executing on a plan to invest nearly $750 million in charging infrastructure initiatives, predominantly in the east of the USA. Public and private entities coming together to build out the nation's charging infrastructure, which is very impressive. So they get a little funding from the government. Will help with coast-to-coast EV travel and connecting communities across America, which is going to be very important because America is such a large place that 500 mile with an hour charging is not really very convenient, and these faster chargers and wider infrastructure are going to make this possible, because this is a real problem for a lot of people, is they're just not going to be able to get across state lines with 400 mile charge range, 300 mile charge range, and not being able to find a charging station. That is just unacceptable, and they will stick with ICE vehicles for as long as possible. Making it easier for people to buy EVs with improved infrastructure is going to be absolutely key, and I'm really pleased to see that they're moving on this. GM is a consistently free cash flow positive business, but it did have a bit of a scare in April 2020 because money was drying up essentially, so they cancelled the quarterly dividend, or well, we can say suspended it, because they're now bringing that back, but a roughly 76% reduction, so it's just going to be 9 cents per share on a quarterly basis, down from 38 cents per share in 2020. Now I'm actually quite happy with this because I believe that money is much better spent on improving cruise automation, on building out their infrastructure and investing in new product lines, because I think this is really an underrated growth potential to be an underrated growth stock. So paying a dividend is not my first thought, but around a 1% yield I'm not really concerned. They're also initiating some opportunistic share repurchases. They're increasing their authorization from $3.3 billion to $5 billion. So that's what, 9% of the shares outstanding at the minute, which is quite a lot, but I think reasonable, because I think the stock price is quite depressed at the minute. A price to earnings ratio of around 7 seems cheap to me. Speaking of PE ratio, let's look at some valuation metrics and some margin metrics. PE ratio on a trailing basis of 7.4, which is not overly cheap for General Motors history because it's been depressed for quite a while. That is very cheap for the automotive industry. Forward PE ratio of just above 6, very cheap for the automotive industry, both far below the S&P 500 averages. A PEG ratio of 3 is not cheap by any means in my opinion, and 1 to 2 I would consider reasonable valuation. This is a little above where I would like it to be, because it's not expecting tons and tons of growth in the near future. That is more backloaded to 2025 plus, so there's a bit of a medium to long term outlook on this stock if you want to believe that it's going to do incredible numbers. That's why they're repurchasing shares and things like that to provide shareholder value in the near term. Price to operating cash flow of 4.75 is again incredibly cheap. This is a company that generates a lot of cash flow, and at just 4.75, that is very, very cheap, one of the cheapest numbers you'll likely to see. Looking at some balance sheet metrics, has a cash to debt ratio of 0.24. There is a lot of debt on this balance sheet, don't get me wrong. However, quite a lot of that is tied up in GM Financial, which is kind of like Ford Credit. It's the facility for offering auto loans, so it's not absolutely ridiculously debt loaded, but it does have a significant amount of debt. Roughly similar to its market cap in just liabilities excluding GM Financial. So that is something people should be aware of. However, it's very free cash flow generative. It's traditionally managed debt okay over the short term, and it handled a number of crises quite well. So I'm not overly concerned about that in the near term. I think Mary Barra is an excellent owner operator, and she's done really well managing this company's debt load. Gross margin percentage of 13% is nothing special for the car industry and the automotive industry. It's not Tesla by any means, but that is decent for a legacy automaker. A net margin of 6.7% is again not Tesla by any means, but decent. Of course, they are expecting this to go up with the software packages and the ultimate infrastructure network. They're expecting these higher gross margin products to push that net margin up over the years to more like the 15-20% range, which would be more in line with Tesla. Return on equity percentage of 13 is not amazing, and a return on asset percentage of 3.5 is again not amazing. These are on the lower end of what I would expect for a company like this. A return on invested capital percentage is not very impressive in my opinion at 3.38. They've definitely got some work to do here. Next up, a discount cash flow analysis to work out an intrinsic valuation for this company. Now, I'm using earnings per share here, which is a bit of projection. That's because the free cash flow numbers are typically a bit all over the place. For this, I decided to go as conservative as possible, really. They've grew their earnings per share around 4.3% annualised over the last 10 years. But for this, I decided to use a growth rate of 0% and a terminal stage growth rate of 0% to give you an idea of how undervalued this company is potentially on an intrinsic valuation basis. So I used a discount of 10%, which is even higher than what I would expect for long-term returns to the stock market, and that gave a fair valuation of $44.78. So based on the earnings per share of this company right now, it has a 14% margin of safety and a significant discount to its present day stock price of $38. Now, of course, there's a degree of projection here because we're not using free cash flow numbers, but free cash flow numbers have tend to be a bit spotty. They make good operating cash flow, and the earnings per share have gone up over time. It's not the end of the world, in my opinion. However, I think this is a fantastic company trading at a reasonable price. If you think this company is going to have any growth in the near future, then this is a very, very cheap company, in my opinion. And I'm thinking about adding some shares in the near future. Of course, it's just my opinion. You should let me know in the comments below what you think is going to happen. Do you think it's going to be ate by the competition? Or do you think it can succeed over the longer term? Or do you think it's just going to remain as it is, essentially? Let me know what you think in the comments down below. Like and subscribe if you're enjoying the video. I'll see you next time.